The Federal Reserve is in quite a conundrum. Rates are too high, yet rates are too low. What people don't realize is there's a little known calculation that actually helps identify this. We're going to talk about it and reveal it to you right now.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
The Federal Reserve finds itself in quite a conundrum right now where rates are too high, yet somehow they're actually still too low. We're going to talk about that confusing statement in just a moment, as it impacts a great deal, obviously, in our economy, in our stock market, in really all things economic, if you will. Also, as always, we're going to go through market data. That data is as of last Friday, which is March 22nd. So let's dive right in. Now, there's a very interesting article. If you'd like to go check out the whole article, it's in the Wall Street Journal. It's from March 21st, so just towards the end of last week. And as you can see here, the title of the article is "The Fed's Conundrum: Interest Rates Are Both Too High and Too Low. Short-term rates are sharply higher. Long-term rates are steadier. What's the central bank to do?" Now, this is an unbelievably detailed and can be confusing discussion. And very seldom do I see a good explanation of this, but I thought this article did a really good job. So I'm not going to mess with the perfection of how this is worded. I'm going to take a moment and do something I don't usually do with you here in the Trending Report. And I'm going to read to you a few paragraphs to get us on the same page. There is an endpoint, so please hang with me. It's important because it sets the stage for the interest rates where they currently are versus calculations and calculated where they should be. And then we're going to get into an explanation of something called the Taylor rule, which the Federal Reserve relies upon to a great deal, and most people simply aren't even aware of it. So here we go. The Federal Reserve is still aiming to lower interest rates later this year, and for many U.S. households and small businesses, those rate cuts can't come soon enough. But for big companies able to tap the corporate bond market, and for investors riding a rising stock market, relief from the Fed doesn't seem all that necessary. The Fed on Wednesday, that's last Wednesday, left its federal funds rate target steady at a range of 5.25% to 5.5%, the highest level in more than 2 decades. But it left in place plans to cut interest rates this year. Fed Chair Jerome Powell again characterized the level of rates as restrictive and said that it will likely be appropriate to begin dialing back policy restraint at some point this year. Changes in the Fed's benchmark Fed funds rate have a strong effect on a variety of short-term rates, such as those on bank deposits and money market funds, but their influence on longer-term rates, such as those on corporate bonds, can be more tenuous. Upper right. The idea that the Fed's target rate is restrictive is driven by a variety of models, many of them versions of the Taylor rule. We're going to get into that. But put forth by the Stanford economist John Taylor. These calculate whether the Fed should set rates based on its inflation target, current inflation, estimates of how much slack there is in the economy, and estimates of where rates will eventually need to settle. 3 versions of the rule calculated by the Atlanta Fed suggest that the Fed's target rate should now be 3.9% to 4.7%, which is significantly different than 5.25 to 5.5. A lot of Americans probably don't need to consult the Taylor rule to conclude rates are restrictive. They can just look at the interest rates on their credit card accounts that are being charged. The average interest rate on commercial bank credit card plans for the fourth quarter was 21.5%, according to the Fed. That is the highest in 30 years of available data, and compares with just 14.9% in the fourth quarter of 2019, just before the pandemic hit. Now, recent research from former U.S. Treasury Secretary Larry Summers and co-authors suggests that households' high borrowing costs might even help explain what has been a bit of a mystery. why, despite a strong job market and moderating inflation, consumer moods remain so dour. Small businesses, too, often tap credit cards, with a recent Fed survey finding that 56% of them regularly use cards for financing, more than any other source of credit. Lines of credit, also commonly used by small businesses, are also tied to short-term rates. Constraints on small businesses can translate into less robust job growth. Companies with fewer than 100 employees account for about a third of the private employment, while research has shown that young small businesses on the way to becoming larger ones are a deciding factor in the U.S. job growth. So in a nutshell, they're saying, as the title would relay to you, that interest rates are both too high and yet too low. The current statement for the Feds is 5.25 to 5.5. The Taylor rule, as calculated by the Atlanta Fed, is saying it should be 3.9 to 4.7. So let's look at what this is. Now, if you go out, if you're interested in this stuff and you really want to make your head hurt, you can go to the Federal Reserve Bank of Atlanta's website, look for the Taylor rule, and you will see that they actually chart it out. Now, this is the rule itself. I'm not even going to attempt to explain that. That is beyond my pay grade. But that being said, it gets graphed. It's going back here to the 1980s, as you can see over here on the chart, and back up until 2012. All they did is track the actual Fed funds rate and what is currently referred to as alternative 3. They added alternative 1 and alternative 2 in 2012, and that's right here. Now, this is what was referred to in the article when they talked about the 3 alternatives or the 3 versions of the Taylor rule being calculated on the Federal Reserve Bank of Atlanta's website. This is what they're referring to. Now, if we zoom in to this area here that I've got in the dotted red line, so 2012 till now, when they've been calculating the 3 versions, that is right over here, just so we can see it nice and tight. Now, from, say, 2012 specifically, up until the pandemic, you can see the kind of the trend up. Now, the yellow, the green, and this dark blue line, so everything but this purple line. So this purple line right here on the bottom, that's the actual Fed funds rate. The other 3 lines above it, those are the 3 alternative variations of the Taylor rule being calculated. As you can see, they're all edging up. And although the actual rate was beneath it, it was following the same pattern. And then the crisis hits, or excuse me, the pandemic hits. And all of a sudden, these things all drop below 0. So the 3 calculations drop below 0. The Fed funds goes to 0 and flatlines. Now they skyrocket back up. And as you can see, we've got this gap right here. And this is the Fed trying to increase interest rates. So we've been talking about this for, quarters and quarters now. The Fed increasing interest rates. This is what they've been trying to do. They've been trying to catch up to this curve. Now this curve is coming back down, and the Fed funds rate actually is above it. If you look at that, a little peak right there, it's coming in above the 3 calculations. It hasn't done that since 2012. When it was actually above 1 of the 3 calculations, but below the other 2. So it's been a long time. It's been over 10 years since we've seen the Fed fund rates higher than the 3 alternative calculations. And yet that's where it is right now. So that's kind of the science behind the statement that the rates are too high, yet somehow they're still too low. The Fed fund rate is, in fact, too high based on the 3 alternatives of the rule. But there's other things in the economy that are telling the Feds that the rate isn't high enough, like the fact that the job market is, in fact, so robust. We've talked about that in previous trend reports. It's almost like another conundrum where, you want a strong job market, but yet the Feds have been trying to cool it off because they believe that the connection to high interest rates, or to inflation, I should say, that there is a connection there. And so they want to cool off job markets to bring inflation down. So there's a lot of moving parts to this, but that is what Taylor rule is all about. So Go amaze your friends and talk to them when they say, well, I wonder why the Fed funds are doing such and such with the interest rates. You can respond and say, oh, well, that's because the three alternative versions of the Taylor rule would indicate that the Fed should do X. And everybody's going to think you're super smart. So check that out. The Federal Reserve Bank of Atlanta does calculate this. You can pull up these graphs with a little bit of work. You can pull up what I've done for you here, and they do keep that up to date on a going forward basis. So obviously the Feds are talking about lowering the interest rates in the future. They want to start doing that. I believe that later this year you are in fact going to see that happen. However, that being said, they also are concerned that inflation isn't cooling off the way they want it to, and that the job market is remaining so robust. So it's going to be a bit of a balancing act. And I'm sure, although you haven't heard a lot about the Taylor rule in the past, I would imagine you might be hearing more about it in the near future. Let's move on to what the markets have been doing now. So here we are with a 1-year look at the various capitalizations. So what we do here each and every time we have the trend report, we run the analysis showing you from large cap down to small cap where things are in the market. Now we've got this blue bar right here because we're showing you the overall stock market according to the Vanguard Total Stock Market ETF. And that's this graph that we see now over here on the right. And you can get a feel for what's going on because these green dots and these red dots, that's our swing, as we call it, kind of a little bit of a shorter term view. And then we've got down here in the bottom, we've got our trend. And what you like to see in a strong market is both the swing and the trend kind of validating each other. They're either both bullish or, worse yet, they would be both bearish or maybe one of each. So right now we're seeing, if you look up these columns, these dots, we're seeing almost all green. In fact, we are seeing all green on the trends. We're seeing all green except for on small cap right here. We're seeing a red swing, but everything else is green. And the overall trend is all green. And what you're seeing now is the reason we go in on the total stock market is it gives you a view of what's elevating the overall market and what's kind of dragging it down. Because if the overall market is kind of the average, then we can look and see, well, where are the strong points that are elevating it and where are the weaker points that are pulling it down? The strong points these days, up here at the top of the list, scoring out based on trend, are all of your large cap indicators, or indexes. The S&P 500, QQQ is the NASDAQ 100. You've got the Dow Jones 30 Industrial Average, and then you've got the S&P 100, which is the 100 largest stocks within the S&P 500. And then, as we were commenting on a moment ago, you see all the mid caps and small caps down here. Russell 2000 is small cap, the small cap 600 growth, the mid caps are here, the overall 600 index, and then the value portion of the small cap index. All of them are down towards the bottom. But overall, we're seeing a very strong market right now. We're at all new market highs here in many of the indexes these days. But you've got the strong green indicator here for your swing, and we're getting all kinds of green down here in the trend as well. Now let's take a look at the sectors. So here we're subsetting for you based on capitalization. Now let's subset based on sector. There are 11 different sectors in the stock market. We add in gold and silver to kind of round things out for you here. But if we take an equal weighting of all those sectors, we would come in right here. Again, relatively middle of the pack. And that's sort of how this should work. The average should be somewhere in the middle of the pack, not out at one of the extremes. And so here we're seeing something that looks pretty similar to the previous page. We've got a pretty strong swing coming through here. We've got a very strong swing here. We've got strong trend in bullish here with lots of green. And in the middle here, we saw a bearish swing. And then we also saw a shorter bearish trend before they both turned around right about at the same time, right in this area. My drawing is not the best, but then you see we're looking quite bullish. So what's been lifting up the overall sectors? Well, it's been information, industrials, financials, telecom, and the like. And what's been dragging it down? Utilities, energy, and real estate. And then we do see silver in here. We see gold right up here. But if we're looking just at the sectors, this is real estate, this is energy, and this is utilities, kind of dragging things down, if you will. Now, if we want to take a look at international, it's a little bumpier ride on the international side, but here's the overall international. And as you can see, we're getting these little stripes of bearish swing before we get the strong bearish swing. So although we had good trend here, we were seeing, the swing was starting to tell us, hey, there's some issues here. And then all of a sudden the trend did go bearish back in October, November of last year. And now we've got a bullish trend again. And we've got a bullish swing taking place here in the international as well. So a bouncier ride, but seems like that ship is starting to steady. And just as a comparison, we throw the S&P 500 in here so you can see how it's stacking up against the rest of the world, so to speak. And as you can see, it's at the top of the list. So it tells us that the U.S. market overall is stronger than really what's going on internationally. And then what's pulling things down? Latin America, emerging markets, small caps across the globe, and the like. Up here, we're seeing some of the bigger index stuff, MSCI and the growth index. We've got Pacific is up here as well. And then at the very bottom of everything, we talked about this a couple of trend reports ago, but China is down here. It's the only one with a red bearish indicator on the trend. It is coming in negative on the trend, but right now it did get a little turn up on its swing, which again is a shorter term view of things. And then finally, we look at the bond market. The bond market, again, very much affected by what's been going on with interest rates. The overall bond market here in the center, which is also the graphic to the right, what's been elevating the bond market are high yield corporates and municipals and short-term corporates. So basically the corporate stuff is all up here. And then the governmental stuff, all the treasuries are really down here with only internationals coming in lower. But as you'll notice, we've got bullish trend across the board, but then we've got all kinds of bearish flashings taking place at the swing as of now. So we had this long bearish run coming in from June through November in terms of the swing. And then the trend actually went bearish at about the same time. They both then turned bullish in here. But now look at this right here. We're getting that bearish swing has taken back over, even though the trend is still showing bullish. So right now we're getting some flashing indicators opposite each other, which tells us that things might be starting to swing back towards a bearish. If they do, you'll see the trend follow to red as well. Or if things turn back around, you'll see the swing go back to green and the trend prevailing. That's yet to be seen. But again, keep an eye on those Fed interest rates because that will play out over here in the bond market as well. Hope this has been useful for you. Hope it's been entertaining. And I hope you learned something today. Thanks so much for trusting us with your investment dollars. We'll talk again soon.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.